Good day, my name is Tsholo Tshoke. I am a standard setter at the Accounting Standards Board. This presentation is to discuss the interpretation of the standards of GRAP on liabilities to pay levies, IGRAP 19. The objective of this presentation is to discuss with you some of the key principles that we find in IGRAP 19. So I will be covering with you today the background and purpose of IGRAP 19. What is the definition of a levy? I will take you through the scope of IGRAP 19. I will also discuss with you the issues and consensus that are included in the interpretation. That will then be followed up with other considerations, and then we will finish off with the effective date and transitional provisions. Why was IGRAP 19 developed? A project was added by the board when it questioned the inclusion of the IASB's IFRIC 21 on levies on its reporting framework for 2014-15. The board was uncertain whether it was appropriate to add IFRIC 21 to its reporting framework because it was uncertain about the appropriateness of IFRIC 21 for the public sector. As part of that process, the board then decided that it would add a project to its work program to determine the appropriateness of IFRIC 21 for the public sector. As the initial phase of that project, the Secretariat was tasked with determining whether IFRIC 21 would be appropriate for the public sector. That analysis included looking at whether there were transactions that are within the scope of IFRIC 21 in the public sector. There we considered the nature and frequency of such transactions. The board then concluded as part of that project that IFRIC 21 was appropriate for the public sector, and then it decided that it would develop an equivalent of IFRIC 21, which is IGRAP 19. So IGRAP 19 has been developed and it is primarily drawn from IFRIC 21 on levies. So what is the purpose of IGRAP 19? In this slide, I have provided you with a diagram of essentially the transactions that are applicable for IGRAP 19. So we will then start off with, we have the government. So the government, as a result of legislation, can impose levies on individuals as well as entities. So essentially the government will then collect revenue on these levies that it imposes on individuals and entities. But this IGRAP does not deal with the revenue side of the transaction, because the requirements around the timing and the recognition of revenue for the government would be covered under GRAP 23 or GRAP 9. So the purpose of this IGRAP is to really look into those transactions. This is now on the reporting entity. So the reporting entity is that entity that needs to pay these levies that have been imposed by the government. So we will call this the reporting entity. So the reporting entity, based on legislation, has an obligation to pay levies as required by legislation or similar means. So essentially what that means is that this reporting entity has an obligation to pay a levy, which will be recognized in accordance with GRAP 19. GRAP 19 is the standard of GRAP that deals with provisions, contingent liabilities, as well as contingent assets. So what the board found was that the timing and recognition of these obligations to pay levies is not very clear when you read GRAP 19. So the purpose of this IGRAP is to clarify the timing and the recognition of liabilities to pay levies. This is now IGRAP 19. So a levy is defined as follows. It is a non-exchange transaction resulting in an outflow of resources, that is your future economic benefits or service potential, and it is imposed by government on entities as per legislation or similar means. So in the next couple of slides, I will take you through these three key aspects of the definition of a liability and what it means. Because if we understand what a levy is, then we can then apply the scope inclusions and scope exclusions that you find in IGRAP 19. Firstly, is the outflow a non-exchange transaction? For us to assess whether a transaction is exchange or non-exchange, we need to look at whether there has been a direct exchange of approximately equal value. That is how an exchange transaction has been defined in IGRAP 9 or in IGRAP 23. So you will need to consider, is the outflow a non-exchange transaction? Exchange transactions are executory in nature. So what that means is that the parties to the transaction need to perform. What the board found was that it is usually easier to identify the point of recognition for exchange transactions, and the board decided that exchange transactions should not be included in the scope of IGRAP 19. So where does that leave us? So this means that the first thing that you need to assess is whether you have an exchange transaction or a non-exchange transaction. If the transaction is an exchange transaction, it means that the entity will be receiving an asset or it will be provided goods and services from the transactions, and those are scoped out of this interpretation. This interpretation only deals with those outflows that are non-exchange in nature. The second thing that we need to assess is whether the outflow is a levy. Now, determining whether an item is a levy that is within the scope of IGRAP 19 may be challenging. And the reason for this is that sometimes these items or outflows or payments are not referred to as levies in legislation. They may be referred to using other terms. So what you need to do is that you need to consider the substance of the outflow rather than the use of the term levy. Let's look at some examples. So on this slide, I've included some examples of levies. So in legislation, these outflows can be referred to as levies. They can be referred to as taxes, for example, your non-refundable purchase taxes, property taxes. They can also be referred to as fees, for example, license fees, or concessions, tolls, duties, royalties, tariffs, payments, or charges. But as I have said earlier on, that what you need to remember is that you need to look at the substance of the outflow or the substance of the transaction rather than whether the outflow is being referred to as a levy. Next, we need to look at, is the outflow imposed by government? A government has been defined as the national government, it could be the provincial government, or even the local government, or it could be another international government for purposes of this IGRAP. It's important for us to assess whether the outflow has been imposed by government, and the reason for this is that sometimes in legislation it may be a requirement that another entity collects the levies on behalf of government. But for purposes of this IGRAP, we need to look at the underlying transaction. So if there is another third party that collects the levies on behalf of government, as the reporting entity, you need to determine whether the underlying transaction is actually being imposed by government rather than the party that is acting on behalf of government. So IGRAP 19 does not apply to those transactions that are between the collecting agent and the government. IGRAP 19 will, however, apply to the transaction between the entity which has an obligation to pay the levy if it meets the requirements of IGRAP 19. So I have explained to you what is a levy. So there are those transactions that have been scoped out of this IGRAP because they do not meet the definition of a levy. These are the following. So where you have an outflow from resources that are covered by other standards, then IGRAP 19 does not apply. A simple example is income taxes. For income taxes, entities need to apply the standard that has been issued by the International Accounting Standards Board, that is the IASB, and that is IAS 12 on income taxes. So if we had to look at the IGRAP framework, if there are any levies that are employee-related expenses, then an entity would apply IGRAP 25. So for that reason, any employee-related expenses are not covered by this IGRAP. If you have any fines or penalties, those are also not considered to be a levy for purposes of IGRAP 19. And the reason for this is that usually these fines or penalties have been imposed for breaches in legislation. As such, they are not included in IGRAP 19. We also have emissions trading schemes, which are not considered levies for purposes of this IGRAP. Let's look at the scope. By the scope, we consider which transactions are included in IGRAP 19 and which ones are excluded from IGRAP 19. Let's start with those transactions that are covered in IGRAP 19. So IGRAP 19 is an interpretation of IGRAP 19, that is the standard that deals with provisions, contingent liabilities, as well as contingent assets. So this means that only those liabilities to pay a levy that are within the scope of IGRAP 19 are included. It also covers those liabilities with certain timing and amount. What IGRAP 19 does is that it clarifies when these liabilities should be recognized. So which transactions are not covered in IGRAP 19? IGRAP 19 does not deal with the debit side of the transaction. So this IGRAP would not tell you whether you need to recognize an expense or an asset as a result of the levy. It also does not address measurement of these liabilities. So the measurement of these liabilities you would need to apply IGRAP 19. As with any other interpretation that has been issued by the board, we have a section that deals with issues and consensus. So there are 5 issues that are being addressed in this interpretation, and all of these issues relate to when should a liability to pay a levy be recognized. The first issue is, what is the obligating event that gives rise to the recognition of a liability to pay a levy? The second issue looks at, does economic compulsion to continue to operate in a future period create a constructive obligation to pay a levy that will be triggered by operating in a future period? The third issue is, does the going concern assumption imply that an entity has a present obligation to pay a levy that will be triggered by operating in a future period? The fourth issue is, does the recognition of a liability to pay a levy arise at a point in time, or does it arise progressively over time? And then lastly, what is the obligating event that gives rise to the recognition of a liability to pay a levy that is triggered if a minimum threshold is reached? We will discuss each one of these issues together with its consensus and also give you an example. So the first issue, what is the obligating event giving rise to the recognition of a liability to pay a levy? The board's consensus is that the obligating event is the activity that triggers the payment of that levy. So that activity will usually be identified in legislation or similar means. Let's look at an example. So legislation requires a regulator to impose a levy on distributors of electricity. Entity A is a licensed electricity distributor. The levy is determined based on the electricity that has been distributed during the current period. In analyzing the facts, we can say if we had to apply the consensus to issue 1 about the obligating event, the activity that triggers the payment of the levy will be the distribution of electricity throughout the current period. So the obligating event in this case is the distribution of the electricity in the current period. So at any point in time in the current reporting period, Entity A has a present obligation to pay a levy on the electricity that it has distributed to date. Issue number 2. Does economic compulsion to continue operating in a future period create a constructive obligation for the entity. The board's consensus to this issue is that the fact that an entity is economically compelled to continue operating in a future period does not create an obligation to pay a levy that will arise from operating in the future. What the board said, and this is in line with the principles that are already in IGRAP 19, is that the past event cannot be as a result of a future activity, which is why economic compulsion to continue to operate in the future period will not create a constructive obligation. Example 2. So example 2 is based on the same fact pattern that we discussed in example 1. So if we had to apply the second consensus to issue number 2, then entity A has no present obligation to pay a levy on the electricity that will be distributed in the future. Issue number 3. Does the going concern assumption imply that an entity has a present obligation to pay a levy that will be triggered by operating in a future period? Similar to issue number 2, the fact that an entity prepares its financial statements under the going concern principle does not create an obligation to pay a levy that will arise from operating in the future. So the fact that an entity will apply the going concern principle, that does not mean that an entity has a present obligation to pay the levy in future. Issue number 4 is, does the recognition of a liability to pay a levy arise at a point in time, or does it arise progressively over time? The board's consensus is that a liability to pay a levy is recognized when the obligating event occurs. This might arise at a specific point in time, or it might occur progressively over time. Let's look at another example, example 3. Some background to example 3. Property taxes are levied annually and payable at varying times throughout the year. Entity B is obligated to pay property tax to a municipality in accordance with legislation or similar means. The property tax is levied at 1% of the assessed value of the property on 1 July each year, payable in 12 equal installments. The entity's reporting period is 1 April 20x1 to 31st March 20x2. Let's look at the analysis. So the liability is recognized in full on 1 July 20x1 as the obligating event is the ownership of property on a specified date, which in this example is the assessment date. Any payments that have been made by the entity between 1 July 20x1 and the 31st of March 20x2 will reduce the entity's obligation to the municipality. Any payments made before the obligating event will be recognized as a prepayment. So that is an asset. The last issue is, what is the obligating event that gives rise to the recognition of a liability to pay a levy that is triggered if a minimum threshold is reached? So the board's consensus was that IGRAP 19 is explicit that the same principles should be applied for obligations that have minimum thresholds. So what this means is that a liability is recognized when the minimum threshold has been reached. Let's have a look at another example. Some background information to example 4. Entity D has a reporting period that ends on 31st of March 20x1. In accordance with legislation or similar means, a levy is triggered if an entity generates revenue that's above 50 million rands in 20x1. The amount of the levy is calculated by reference to the revenue generated above 50 million rands, with the levy rate at 0% for the first 50 million rands revenue generated and 2% above 50 million the 50 million rand revenue. Entity D's revenue reaches the revenue threshold of 50 million rands on the 17th of January 20X1. The analysis for example 1 is as follows. The liability is recognized between 17th January 20X1 and the 31st of March 20X1 as entity D generates revenue above the threshold, because the obligating event is the activity that has been undertaken after the threshold is reached, i.e., the generation of revenue after the threshold is reached. So the amount of the liability will be based on the revenue generated to date that exceeds the threshold of 50 million rand revenue. Some other considerations. So how should an entity account for a levy that has been prepaid? As I had already illustrated in one of the examples, an entity should recognize an asset if it has paid a levy before the obligating event. So essentially, we call this a prepayment. Is VAT within the scope of IGRAP 19? The board considered whether VAT meets the definition of a levy in IGRAP 19. With registered vendors, the board's outlook was as follows. VAT is usually raised for the government by requiring vendors to register and charge VAT on taxable supplies of goods and services. And it also allows them to claim the VAT on the purchases that they have been made. The net amount is either paid or received from the Revenue Authority. The board was of the view that in such a case, entities are in fact acting as agents of government in that they are collecting and remitting these VAT payments to the government. The board was of the view that the transaction between the government and the collecting or remitting entity is not considered a levy for purposes of this IGRAP. When it comes to non-registered VAT vendors, the VAT that has been paid by the entity is in fact a non-refundable purchase tax, which meets the definition of a levy in IGRAP 19. The board did, however, observe that with the case of non-refundable purchase taxes or VAT that has been paid by non-registered vendors, that there may be different obligating events. So let's look at a simple provision that has been raised. The board observed that for certain transactions, there may be different obligating events for the recognition of VAT and other outflows within a single transaction. For example, when we are raising a provision. When applying this interpretation to provisions, it may mean that there are actually two different obligating events. We have now reached the end of our presentation, but before I end off, I would just like to take you through the effective date and transitional provisions. So an entity should apply IGRAP 19 for reporting periods that begin on or after 1 April 2019. IGRAP 19 can be applied earlier than 1 April 2019. But if an entity does apply this interpretation earlier, then it should disclose that fact. Changes in accounting policies resulting from the initial application of IGRAP 19 should be accounted for in accordance with GRAP 3. Thank you for tuning in. If you would like to get in touch with us, you can find our contact details on the last slide of this presentation.